So the Federal Reserve had their meeting this week, and if you're interested to see what happened in layman's terms, this is a great place for you. If you're also interested to see and hear about the market outlook for 2024, we're going to talk all about that. Let's get going. So I'm here with Ashley Schnetzer, and she is our controller at Morgan Financial, but she does a lot more than that. Help them understand what you do here, if you could break it down to just a couple paragraphs.
A couple things, yeah.
Okay.
So yeah, I'm the controller here. I also head up, that means basically I head up the accounting process here. And a part of that process includes, as well as preparing our budget. We maintain a quarterly budget as well as an annual budget, as well as updating our forecasts and our predictions for the future. So that's my official title is controller. And so it's all the things that happen in a business that maybe aren't necessarily just originating a mortgage.
All right, she's being a little modest. She handles the support department, which covers accounting, finance, IT, HR, and probably some other all those duties signed.
All those things. Yep, all of the vendor relations, the investors and things like that. Yep.
Cool. And so I thought it'd be a great idea to have Ashley on to talk about the Fed meeting today. It was today. You might be watching this tomorrow or next week. Who knows? But also just outlook predictions, because as we work on our budget for 2024, she's reading all the data out there from the MBA, from NAR probably, and other big institutions like that.
Absolutely, and it's great timing as well because we're talking about it being November,
right,
which means now we're looking at some of the financial data coming out from the end of last quarter as well, especially coming from the Fannie and Freddie.
Cool.
Yeah.
So let's talk about the Fed first. So the Fed met today, and a lot of eyes are on the Fed.
Absolutely.
And so why are a lot of eyes? In your mind, why are the eyes on the Fed right now?
I mean, the eyes are on the Fed because of the interest rate predictions. Maybe even more so the actual comments and the idea of what the Fed might do next, even more so than what they actually do.
Right.
Yeah.
Yeah, because like today they announced that there was no rate hike, right?
Right, which was expected.
Expected.
Yeah.
How did the markets react?
They actually, they ended up being more positive, ended up going up a little bit even more. They opened up a little bit they opened up a little bit better today, and they've continued to kind of see a little bit more in the positive territory after that, as far as the bond market.
Bond market. Okay, I was going to say, so that's the bond market. And,
right.
And when it opens up, when we say it's good, that means rates are getting better.
Correct. Yep.
So today the rates might have improved just a teeny tiny bit.
Just a teeny tiny bit, not significant, not going back down to anything that we saw before.
Right, but that improvement might make the difference of an 0.1% in the interest rate. So it might make an impact if someone was shopping yesterday, but they want to lock today. The rates might gotten a little bit better for them.
Absolutely.
Cool.
Yeah.
Awesome. And then so what other impact does this announcement by the Fed have today?
I mean, a lot of the times what usually ends up happening is the statements that they actually make. They make a formal statement. They, very much consider very carefully the language of the official statement that they put out there. And then, of course, Chairman Powell also does a press conference, and a lot of what he states is very much, scrutinized by the entire market and all the economists. The whole world.
Yeah.
To try to understand some kind of indication of what they're going to do next, right?
And from what I read, they usually give a statement, right?
Right.
And that statement is pretty generic, and they will change very specific pieces of that statement.
Very specific things.
I mean, the statement's exactly the same as last month, except they changed two different little pieces, right?
Yeah, they changed some things about the labor market, starting to see some more moderate growth rather than substantial growth. And then they also changed something that could be potentially significant insofar as they talked a lot about the changes in credit conditions as being something that they're watching. This time they talked a lot in terms of what financial and credit conditions they might be watching. In other words, they're possibly looking at things that they themselves didn't actually directly control that might impact interest rates, such as like possible government shutdown, as for instance.
Right.
The war, and the issues happening in the Middle East and things like that might be something that they didn't directly cause.
Gotcha. So you mentioned there's the two pieces. So one of them, they mentioned that employment growth was moderate versus substantial, right?
Yeah.
So that shows a slow in employment growth.
It shows the possibility that they expect that that's going to continue to either be slow or be slower for longer.
Or they use the word moderate, which is a little bit above slow. Moderate is still, this is the thing.
It's
it's so minute. You have to hang on every word that they say, because if they go too aggressive, it will move markets too much in the wrong direction. Then there'll be a correction.
Yeah.
But they literally said moderate versus, what was the term they used before? I can't remember now, but it doesn't matter.
I almost think it was like significant.
Significant versus now it's moderate. So it's a slowing of the growth of the labor market. And the other one they mentioned was to the consumer. They mentioned tightening of credit. Now they mentioned financial conditions and tightening of credit.
Right.
So now the credit tightening that the Fed put on is starting to affect the end consumer, right?
Right. As well as other things that are happening. Student loan repayment program, some of those student loan repayment forgiveness programs ending, and that end up happening again. As well as, some other issues that are happening, like the auto workers, them ending their strike and things like that.
Right. So why is that? I'm going real layman's terms, but why does why is it impacting the consumer? Is it significant to the Fed?
I mean, quite simply, if you have less money to spend, then eventually it'll impact inflation, right? If you have less money to spend, then you can't spend it.
You can't spend as much money.
Right.
So if you can't spend, because the GDP still grew by 4.9% last quarter. And so that's still an increase in GDP. And GDP is like, it's like the revenues for our country, basically.
Right.
And so if the revenues shrink, inflation shrinks too, doesn't it? Or does it not work quite like that?
Yeah, I mean, in terms of like if you literally have less money out there, if you literally have less money to spend, which was, the big part of the reason the inflation problem happened in the first place. There was so much money that was injected into the economy. So many people held on to so much savings for so long. And, at the same time that they literally, certain areas like travel and things like that they actually could not spend that money. So now you have a lot of that loosening up. Yeah.
And what about going back to the labor market? Why is that important to inflation?
I mean, if you have that job, if it's a tight labor market, it means that, getting a job is a little bit more competitive. In other words, getting workers is a little bit more competitive. In order to actually get those workers, you have to retain and attract them. It tends to lead to higher compensation.
Right.
It tends to lead to then more money that ends up, in the hands of the consumer, which then contributes towards inflation.
Well, yeah, and if you have to pay your employees more,
right,
you have to charge more.
That's the other big thing, right?
And if you have to charge more, people have to pay more. That's inflation too.
Exactly. If people literally have more money, they have more money to spend.
Right. And if but
and
by giving them,
to charge
and then
them
we
more.
have to charge more.
Right.
And then they have to get paid more, and then we have
Right.
to charge more, and then
Exactly.
it's the wage price spiral.
Right.
Okay, cool. So let's put this in layman's terms. So or I shouldn't say layman. Let's put it in a form that's relevant to our audience base, which is, we have a lot of real estate agents that watch this show.
Right.
So what would you say to the real estate agent? The outlook for next year? How does it look? Is the world coming to an end? The data and research you've done, is our sales going to go to zero? Is pricing going to go down next year? I need the answer definitively.
Definitively. Okay, great. Pull out the crystal ball.
Yeah.
Yeah. No. From what I've seen, no. The world's not coming to an end.
Okay. Good.
The economy itself, and like most things, is very cyclical, very seasonal. So no, a lot of the forecasts that I've read, whether or not it's from the Mortgage Banking Association or whether or not it's directly from Fannie or Freddie, a lot of their forecasts are showing growth next year. So a lot of that growth might be, centered around certain times of the year rather than consistent throughout the entire year. However, they are predicting anywhere between 18 to 21% as of their most recent forecast in terms of growth in overall mortgage originations.
So that's mortgage originations. Okay.
Correct.
So we have, just to put this in perspective, we have refinances and we have purchase business.
Correct. That makes up both. Yeah.
Makes up both. So are they expecting the purchase market to increase? Sales?
They are expecting the purchase market to increase.
Okay.
It's not going to, they're currently forecasting not as much as like that 18 to 21% for the entire purchase market.
Right.
They're predicting closer to probably more like a 5 to 6 to 7% increase in actual purchase volume. Right. Volume. And so not just units, but volume. They are also expecting that some interest rates might end up coming down, especially in the second half of the next year, and which would contribute towards increase in the refinance.
That triggered that refi.
Right.
The refi business. Now, you said the purchase market volume is going to increase. What about prices? What? And when you say they, who is they?
They.
They're listening.
Yes. I mean, it's largely the economists that are employed by Fannie and Freddie and all the associations. And a lot of this data that they end up basing their decisions on is, and this is why it's so important that it's on a quarterly basis. When you sell directly to Fannie and Freddie, you're required to provide this data to them on a quarterly basis. And so they're able to provide their predictions based on some of this data.
Okay. And so it's Fannie Mae, Freddie Mac, it's NAR also. You're getting data from NAR.
Yeah.
And are there predictions for next year, or what do they call them, outlooks for next year? Are they wildly different? Are they close, or?
They're not too wildly different, to be honest. I mean, you can obviously, there's a range that exists there, and some of that growth range that exists there is also based on where they expect the end of this year to be.
Okay.
In other words, some of them, Fannie tends to be a little bit more conservative on their forecast. And so they're actually predicting that this year will end a little bit smaller than some of the other forecasts that I've seen. But it just means that, kind of the same thing. It's all within the range of expectation. As well as we're talking about forecasts for the entire nation.
Right.
Of course.
Okay. So they said that you said that home price appreciation might be moderate, right?
Home price appreciation, might be kind of moderate, might be even a little bit flat. So we might see some stabilization in some of the home prices.
And that's going to be geographically specific.
I would imagine so, yeah.
So certain areas might see negative growth.
Certain areas, yeah.
And some areas might see greater pockets of growth. So it depends on where you are and the specific situation in that area.
Absolutely.
But nationwide, overall, they're expecting growth, right? In prices, both prices and volume.
Yeah, I mean, overall, they're expecting growth in that volume. They're expecting some of the prices to nationwide to somewhat stabilize. And that could also be just not necessarily because of inflation, but because of the actual potential increase in supply of homes.
More houses coming on the market.
Correct, yeah.
And as rates come down, you might see people more willing to get rid of their low rate and buy what they really want.
Yeah, especially a good indication of that is that they are still seeing an increase, or forecasting rather an increase in new home prices. Okay. So they're seeing an increase in new home prices, but they're seeing that some of the existing home sale prices might end up kind of stabilizing a little bit.
Okay. Good. So any other outlooks or what's your personal prediction? What do you see for next year as far as growth in our industry of real estate?
Yeah, I mean, my personal prediction, obviously we understand that the Fed didn't increase interest rates this week. They are still, markets are still projecting the possibility of some more rate increases. I kind of think that. I personally don't think that's going to happen in December. I think that they're going to lack the information because of the government's potential shutdown. But that's just a guess there. I think that there's a very realistic possibility that they might increase rates again, probably in January or so. But I also think that the market's starting to already kind of
start to feel it. Yeah.
Yeah, they're already kind of baking it in.
Gotcha. Okay.
And so I don't necessarily know how much of an impact that'll actually have on mortgage rates, because I think that maybe that might be the last for a little while. Let's knock on wood here.
Right.
But and then there's a real possibility that some of the interest rates might come down in the second half of next year.
Okay. Well, yeah, I think about the beginning of this year, we were kind of predicting them to be low already, right? Yeah. So a lot of people, myself included, I'll take responsibility. I was like, the rates are going to be down by the end of the year. I was wrong. Okay, it happens. But the data also surprised everyone this year. And
strong data, yeah.
The strong data, and it's fueled by, some would say a lot of, things already in the works. There's a lot of things that go into this.
Yeah.
But, that could happen next year too, right?
Absolutely.
And the rates could stay high through the year. They might come down. The data is already looking like it's starting to level out. And, after a level comes a fall, typically. Yeah. But who knows what can happen? There's a lot of things that can happen between now and then.
I think we've definitely seen that, most recently with some of the things happening overseas, as well as the strikes and things like that.
Yeah, you don't know what's going to – God forbid another COVID happens.
Oh, gosh.
That would be the worst. No one wants that. Nobody.
No.
All right, so before we depart here, any parting words, advice, or any of those people out there that, might be on the fence to buy a home and they're saying, well, I'm going to wait till rates to come down, or – I think the home prices are going to fall next year. What advice would you give to these people?
The best advice I would give to people is that, look, these forecasts, these predictions, they change. They change quickly. They change often. So the best forecast out there is only ever going to be a guess. So if you find something, I mean, if you're in the market for a home, if you're looking for a home, and if you find something that is an opportunity, if you find something that you can afford, you know, there's really, I mean, you can't wait on the future, right? You can't wait on something
like
that hasn't happened yet, and you don't even know if it will. So the reality is that we're making these forecast predictions, and it's based on what we know, but right now, but we don't know what we're not going to know, right?
we don't know what we don't
we don't
know.
know what we don't know, right?
And what we're going to know.
And what we're going to know
Right.
tomorrow or the next day. Yeah.
Cool. Awesome. Well, thank you very much, Ashley.
Yeah.
I really appreciate the time.
Thank you.
Thank you all for watching. Like, subscribe, share. Check out our website. We always put information on the website. This podcast, you know, it's on a lot of different places. Like I said, like and share it with someone who might benefit from this information. That's all I got. We'll see you next time. Thank you.